Hello, ladies and gentlemen. This is Thomas Fross here with Fross and Fross Wealth Management, where, as always, we attempt to be the voice of reason in a world full of the pundits of pessimism and the wall of worry. Today, we're going to be presenting our annual State of the Markets address. Hopefully, you were able to be at the event last Wednesday. We had a few hundred people that were at the event, but we know that some of you are traveling or happen to be up north at this point, or we're doing something else. And so we decided to record this video so you could see exactly what we talked about. What exactly happened last year? Why did it happen? And what is our outlook for 2023? Or 2024 rather. It's going to take a while to get used to that. But before we do, just a few disclosures, just a reminder that there is no perfect investment. All investments carry their own risk. Everybody's situation is different. So today's presentation is, the goal is not to at all give any specific recommendations to anyone that might be watching the video. Also, we don't give tax or legal advice. You might want to take just a moment and pause this video, read the disclosures before we continue. So in today's presentation, we're going to be looking at three specific topics. First of all, review what happened in 2023 and why did it happen. Number two, we're going to take a look at some potential market forces that could affect the market in 2024. And finally, we're going to be looking at reviving some traditional financial wisdom. What are some things to consider and to keep in mind really in any market environment that will help us to be successful? So let's begin by examining lessons that we can learn from 2023 that we can take into the future. First of all, let's go back in time past 2023 and look at what happened in 2022. Now, 2022 is a little bit like a tornado. Why do we say that? Well, when it comes to hurricanes, typically there's plenty of advanced warning. We know that what the cone of certainty is, and we know that weather patterns are developing, and it maybe a week or two in advance we can begin to be prepared, but that's not what happened in 2022. Coming into 2022, the economy was still in recovery mode from COVID. The Fed decided that inflation was a factor and realized that they had to begin to take some specific measures to protect the market from the economy from this ongoing inflation. And they hinted that there may be around 3 rate hikes for 2022. Well, is that what happened? No. Now looking back, we realized that the entire rate hiking period was the equivalent of 17 quarter point moves rather than just 3. And that was like a tornado to the economy. And it was a tornado to stock prices. And we saw quite a pullback. 2022 was the 4th worst year for stocks in history. And it ended up being the the worst year, I should say, for the fixed income market in history. So it was really a tornado. But as I mentioned before, normally years are more like a hurricane, where we know it's coming, we know, so we have some idea of what the economy may look like, and we can plan accordingly. So what was the cone of certainty coming into 2023? Well, if we look at a spaghetti model, we would see that there was all these negative talk about bank collapses and negative market returns, and there was this, whether we're going to have a soft or a hard landing, and would there be continued inflation? And then there was this slight possibility coming into 2023 that there would be a new bull market and that there would not be a recession. But most of the economists, they were over here in the thinking that things would be quite negative for 2023. And so what exactly happened? Well, now looking back, we know that the spaghetti models were essentially wrong, and that the economy continued to do quite well in 2023, and the market did hit all-time highs. But that did not mean that there were not negative predictions, and there continue to be negative predictions, even coming into this year. One of the biggest negative predictions was a dire prediction from the economist Harry Dent, who January 12th of this year, he was on television saying that he was expecting the biggest crash of our lifetime. And so what's the point that economists continue to be pretty negative when it comes to the economy? But so we decided to look back and look at other negative predictions that have been made, or predictions period, to see, do all predictions that are made by economists come true. One of the predictions that we came up with was Paul Krugman back in 1988. Now, he went on to win the Nobel Peace Prize for other things that he said, but one of them was the internet will have no impact on investing. 10 years from now, the phrase information economy will sound silly. Well, clearly that prediction did not come true, just the opposite. Fannie Mae Fannie Mae, I should say, made the prediction these subprime assets are so riskless that their capital for holding them should be under 2%. And that's what he said. Of course, let me explain what that meant. In a simple example, would mean that if institutions could own $100 worth of subprime debt, mortgage loans, they would only need $2 of customer deposits to insure those. Well, now looking back, we know that the economy was, we know that how much worse how bad that prediction was. Jim Cramer on March 11th of 2000, let's see when he said that, 2008. He was asked about Bear Stearns, and he said, no, Bear Stearns is fine. Don't move your money from Bear. It's just fine. And now looking back, we know how wrong he was. But the one going back to Harry Dent, who made this horrible prediction at the beginning of this year, was it the first negative prediction he's made? Well, no, it isn't. In 2009, he published a book entitled The Great Depression Ahead. Well, that was at the bottom of the market. 2009, now looking back, was the bottom of the market. And we went in to have the longest bull market run in history that only ended because of COVID-19. In 2013, he went on to predict a market collapse would happen that year. That didn't happen. In 2016, he said the Dow will be between 3,000 and 5,000 in a few years. And now we know it's over 40,000 just 8 years later. And then back to last year, a crash of a lifetime. So it reminds me of one of the greatest philosophers of our time, maybe the greatest philosopher of our time. That would be Yogi Berra. He said it's tough to make predictions, especially about the future. And even as comical as that is, it's true. It's very difficult to make predictions. And it's a good lesson to all of us that moving into 2024, that there are going to be always very negative. Remember, I said we're the pundits of pessimism and the wall of worry. There are always going to be those things, but it's very difficult to predict the future. So looking into 2024, frankly, the road is a little, it's a little foggy right now, right? Here's what we are looking at. We know there will be an election this year, so how will that affect the market? And the question, will China invade Taiwan and cause another war? Will the Fed continue to raise rates, or will they lower rates? And lastly, do we finally get this big recession that so many economists have been predicting now for the last 2 to 3 years? So let's look at one event that most economists have been forecasting, at least for a couple years, and that is that one to the right there, that recession. So what is the probability that we see a recession in 2024? Well, first of all, you can see that the Fed staff is not predicting a recession for 2024. That's interesting because most others are predicting one. There's a few different ways we look at predictions of a looming recession. We can look at the yield curve. That has historically been the best predictor of recession. We can look at what economists say. We can look at what consumers are predicting. And then we can look at large financial institution and C-class CEOs and see what they predict. So we already said the Fed is not predicting one. The yield curve, when the yield curve inverts, that's when short-term interest rates are paying more than longer-term fixed income instruments. Normally, we think of like a 5-year CD giving us more interest than a 1-year CD. What happens when banks or companies issuing bonds, when interest rates, you get a higher interest rate for shorter periods? Why would they do that? Well, it's because the fixed income market is expecting the economy to soften and the Fed to begin to lower interest rates in the long term. And so they're willing to give higher interest rates today, but lower interest rates in the future. And if we look at that, there's a 61% chance in the fixed income market of there being a recession in 2024. When economists are polled right now, 48% of economists are predicting a looming recession, so less than half. Consumers, investors are 69% are predicting a looming recession. Goldman Sachs, 15% chance is what they're putting on is a recession this year. Bank of America is somewhere between 35 and 40. And interestingly enough, CEOs of large publicly traded companies, this is the Conference Board, the Q3 CEO survey, predicting a recession in the next 12 to 18 months, they put an 84% chance. So what's the bull case now coming into 2024? Well, consumer spending, which makes up 3/4 of the size of our economy, a little over that, about 2/3, about 70%, that they continue to spend money, which keeps the economy moving forward. Bear case is that this household debt, which hit a record of $17 trillion, that puts us in a recession, and that we see large corporate defaults, which have continued to accelerate since 2023. So let's look a little bit more at what the Fed is predicting. The FOMC, or the Federal Open Market Committee, their participants, they put out what they call the dot plot chart that plots out what they feel will happen with interest rates. Why is this important? Well, if we do go into recession, then the Fed would likely lower rates to try to re-stimulate the economy. And so what they do is the different members plot out, once again, where they see interest rates at any given time. And at the end of 2023, they all agreed that interest rates would remain stable in that 5.25% to 5.5% range. Now, their cone of uncertainty starts to get larger moving into 2024. And at the end of 2024, there are 2 members that feel that interest rates will remain where they are. We have 1 member that feel that interest rates will be in that 3/4 to 4% range. So rates would drop by 1.25. And the rest of them are somewhere in the mid-4s. But look how that cone of uncertainty gets larger moving into 2025, where you still have 1 that thinks interest rates will remain where they are. You have another 1 down here that thinks interest rates will be closer to 2%. And most are somewhere in the middle, somewhere in the mid-3s. And by 2026, they start to somewhat agree that interest rates will be back to more normal levels, somewhere in the 2 to maybe 3.5% range. In the long run, most of them agree that interest rates have got to get back in the mid-2s. It's very difficult, though, when we look at predictions on where the market thinks that interest rates are going, what actually happens. What this chart does is it shows what the market predicted interest rates would go and where interest rates actually went. So if you look back at 2008, when interest rates dropped, coming into 2009, the market predicted or expected interest rates to go back up into the mid-3s. That didn't happen. Interest rates actually dropped and dropped to 0 until the end of 2015, even though the market kept expecting interest rates to go up. And then, as we know, interest rates dropped back to 0 when COVID hit. And as interest rates have gone back up significantly, the market has continued to expect that interest rates would begin to stabilize and even come down, although that's not happened yet. So while we continue to at least look at interest rates and where they may be going, It's just important to remember that it's a hairy business. It's very difficult to predict. So what happened in 2023 was that interest rates began to stabilize, and looking back now, we know that we didn't see a recession, that gloom and doom did not occur, the market did not crash, and despite all these hairy predictions, the market actually did quite well in 2023. So that's the wrap up for 2023. But what are we expecting for 2024, and for not just the market, but also for the economy? Let's talk a little bit more about this prediction of a recession, because most are still waiting. When is this recession going to occur? I would argue that the recession already happened, but it didn't happen in the way that we normally expect. Normally, when we have a recession, it hits most of the parts of the economy at the same time. Maybe you think of the recession that we saw in the late 70s or early 80s, or in the late, from 2000 through 2003, or maybe the financial crisis and the recession that occurred. We know what a recession feels like. People are out of a job, and most of the sectors of the economy are shrinking at the same time. But the reason I would argue that perhaps we've already had it was because we've already had a recession in 6 of the key areas of our economy, just at different times. So the box in the top left looks at the recession that we saw in the travel industry. We had that recession in 2020 when COVID was rampant. And then in 2021, at the bottom left, we saw a recession in the chemical production index. So chemical manufacturing, we saw one. Also in 2020, we saw a manufacturing recession and a housing recession that we saw in 2022. We saw an oil recession in 2020. And lastly, last year, sorry that there's a bubble with my faces on the screen, but we saw a recession in the semiconductor category. So we have had a recession, but just at different times. So we call this a rolling recession. If we're waiting for a recession, here's one thing I'll tell you is that we will have one at some point. We have one on average historically every 3 to 4 years. We just went through from 2009 through 2020 and COVID. We didn't have one for 11 years. One thing looking forward, we're going to have a recession. We just don't know when it will occur. But perhaps from following COVID, we've already had one. Once again, it was just a rolling recession. Now, one thing I want to talk about that does concern us deeply, the sector recovery that we're very concerned about, is the growing federal deficit. It is creating a temporary boost to the growth of the economy, and it's setting up a foundation for the future with the high inflation that we're seeing right now. This would be comparable to FDR's Great Society policies that set us up for the inflation that we saw in the 1970s. So let's look at what the government is doing and how much money they've spent, which has artificially stimulated the economy. The federal budget for 2023 is $6.1 trillion. So it's okay to spend that much money if they have that much money coming in. Well, how much money does the federal government have coming in? 4.4 trillion, which means that's $1.5 trillion, or 1.7 rather, that the government is borrowing, which is staggering. It's staggering to think that they could borrow. I mean, think of your neighbor that is spending $61,000 a year, and you ask them how much they have coming in, and they say $440,000, and you say, well, how can you spend $60,000? And they say, I'm putting it on credit card debt. And that's exactly what the government's doing, but they now have $34 trillion in credit card debt, or in debt that the government now has in the fixed income market that they're spending. this spending isn't an issue that the government seems that they currently want to fix on, certainly on one side of the aisle in Washington. And when their government has stimulated the economy by overspending, it can distort different areas of the economy, like asset prices. Let me prove it to you. Let's see how stimulus can affect the market. So this chart shows two different things. It shows the S&P 500 going back to 2009, and then it looks at M2, or the money supply, the money that's found its way into the economy. This is essentially how much money is being printed. And you can see that up until COVID, those two lines ran in pretty much in tandem. But then COVID hit, and you can see the dark line shot up. That's the trillions of dollars that the government printed during and following COVID. And look how it also brought the stock market up with it. But then as that government spending began to slowly decline, then we saw a pullback in the market. And it didn't just affect the stock market. Look how it affected home prices the same way. And we all can relate. We all know that our house prices shot up during COVID. But there's a direct correlation with what happened with the money supply and the value of asset classes. So I think it'd be important now to look at the market, how the market performs when we have two scenarios. When we have low interest rates, like we had coming into COVID, and until the Fed began to raise rates in the beginning of 2022, and more normalized interest rates. So this chart shows three things. It shows inflation at the bottom, which was up until COVID relatively low. And then the middle represents the federal funds rate. So interest rates stayed at 0 to a quarter point until late 2015 and slowly began to step up. And as you can see, during those real low interest rates that we averaged during the last decade, that the stock market averaged 12.6%, really good performance. The question that we had was, is this environment, are we anytime soon going back to that low interest rate environment? And we don't seem to be. Interest rates have continued to remain pretty low. Now, where are we right now? Well, if you go back to 1870, interest rates averaged somewhere between 3 to 6% and 61% of those times. And that's where we are right now. So rather than being at the real low, near zero interest rates that we sat at for the last decade, we seem to be back into more normal type of interest rates. And so why is the Fed wanting to keep interest rates higher right now? Well, frankly, I think that their biggest fear is that we see a repeat of the 1970s. What happened in the 70s was we saw CPI, or inflation, begin to go up through the mid-70s, and then the Fed got aggressive with raising rates. So interest rates began to fall until around 1977. And then because they had taken their foot off the brake, inflation shot back up to around 15% until the Fed finally had to raise rates to double digits, which crushed the economy, but it also crushed inflation, and we saw inflation dive back down again. Now, where are we today? Well, the black line represents inflation starting in December of 2018. And you can see how the direct correlation that it has with what we went through in the 1970s. This is what the Fed is in fear of. We've seen now inflation begin to level off, but is it back to where they would like to see it in that near 2% range? No, it's much higher than that. And they don't want to see that black line look like the blue line. And that's the reason the Fed has remained aggressive with high interest rates. So if we believe that the Fed learned a lesson from the 70s and they do keep inflation or do keep interest rates at a higher level than that 0 to a quarter, which is our thinking, then what should we expect? Looking back at that period that we just looked at, more normal 3 to 6% inflation and interest rates. Well, if that's the case, then going back to 1950, when we look at more normalized interest rates and inflation, which inflation at the bottom, more normal, higher inflation with higher in interest rates. At that point, during that period, this now up until this looks back at the dates going back to 07 before the Fed lowered rates to near 0, then during that period, the stock market didn't average over 12, it averaged around 8. What does this tell us? It tells us that with more average interest rates, we should expect more muted equity growth. And so maybe that double-digit growth that we've seen over the last decade, I think that maybe we need to be more realistic with what we see the stock market doing until interest rates come back down significantly. Now, one thing we always like to look at is where is the state of the economy here in 2024. Well, I just thought it would be helpful to look at where the economy was 6 months ago. The 20 most important economic indicators, are they red or are they negative? Are they yellow neutral or are they green good? And you can see that in July of 2023, we had 1, 2, 3, 4, 5, 6, 7, and the one bubble you can't see is geopolitical risk on the bottom right. So we had 8, or I should say 7 negative economic indicators. Where are we now at the beginning of 2024? Well, we've seen the economy really begin to improve. Instead of 7, we have 3. Once again, the one you can't see is geopolitical risk, but stock market valuation is still negative because the stock market has gotten a little pricey. International economic outlook is still negative. We have a couple wars going on, and with the war with Israel and the Palestine, and then the war that's going on with Russia and the Ukraine, and do we have one with China again? So that's also negative. But the good news is we've seen the major parts of the economy start to improve. Monetary policy, which was negative 6 months ago, has now become neutral. Credit demand and the LEI, or the leading indexes that were negative, have become positive. Consumer sentiment, or neutral rather, consumer sentiment was neutral. The yield curve, interest rates have now stabilized. So we've seen really an improvement in most of the economy. We're not perfect yet, but it's gotten much better. What are economists predicting for the stock market in 2024? First Trust is a company that looked at 20 of the most probably well-respected economists or strategists and said, where do you see the stock market? What do you see the performance for 2024? You can see there's quite a disparity. You've got on the left side, you've got a few that are expecting that the stock market do over 9%, but then it drops to 7%, and then it begins to drop from there. And there are some that predict that the market could drop almost 12%. So what's our takeaway here? That most strategists, it's difficult for them to agree. Why? Because we don't know what's going to happen with inflation, and we don't know if the Fed is going to continue to pause or if they really get even more aggressive with interest rates trying to slow down the economy. And so it's difficult to know what the stock market's going to do this year. We wish we had the cone of certainty was tighter, but much like moving into 2023, there's a big question mark is what's going to happen this year with the stock market. Knowing that there's a lot of uncertainty, the question is, how should we be positioned moving into now 2024? To answer that question, I thought that we would revive just some traditional financial, some wisdom that will help us in almost any market condition, whether the market continues to do well or if we do see a pullback that some are expecting. So let's look at 5 principles that will help us now moving into into 2024. The first one is that it's time in the market. It's not trying to time the market. We all wish we could be out at the perfect time and we could be in the market at the perfect time. Many years ago, there was a commercial that tried to illustrate people that try to time the market. You might remember there was an older man with a walker, and he's walking along a sidewalk, and he's slowly walking. And to left of him, there's a traffic jam, but there's this car that just is veering left and right and continues to go in the left lane and the right lane. And he's not going anywhere. And then you can see the older gentleman just a mile ahead continuing to walk with a walker. And they were trying to illustrate that it's discipline. It's not trying to get in and out. Now, I'm going to prove to you that it's time in the market and not timing the market. The following chart shows the value of $10,000 if we were to invest in the S&P 500 in 2003 going to the end of 2022. If you would have been invested all of those days, that $10,000 was up 640%. $10,000 was worth $64,844. But imagine you tried to time the market and you were out of the stock market 7 of the best days. That was it. And it's important that you missed 10 of the best days. And it's important that 7 of the best days actually took place during a bear market. So just the idea of we're in a bear market, I'll pull out and I'll go back in when we're out. Well, you would have missed 7 of those 10. But if you would have been out of the stock market 10 of the best days, your $10,000 would have only been worth $29,000. Far cry from $64,000. And if you missed the best 20 days, it was only up 70%. You'd be having $17,000. If you missed the best 30 days, you'd have $11,000. And it's important also to note that in 2020, the second best day happened immediately after the second worst day, going back to 2023. So it's a terrible day. Imagine you pull out, you'd have missed the second best day. You missed the best 40 days, you actually had less money than you originally invested. And you can see what happens by missing the top 50 or the best 60 days. So what's our point? It's trying to time the market's very, very difficult. It's time in the market. It's not trying to time the market. But if we are in the market for a period of time, the fact is our odds of being successful skyrocket. And what we tried to illustrate here is going back to 1950 through January 31st of 2023. 1 month rolling time frames, the market was up 60% of the time. Not bad odds, but if you're in the market for 1 month, difficult to know what's going to happen. If you're in the market for a rolling 12-month time frame, your period of success, your chance of success jumps up to 73%. Over a 30-year time frame, 84% of the time the market was positive. And you can see what happens as we move forward to a 7, 10, 15-year time frames that the market has always given positive returns. Benjamin Graham, he said in the short run, the market's a voting machine. In the long run, it's a weighing machine. Why does he say that? Stocks often, they're like a popularity contest when investors vote with their money over short periods of time. But over long periods of time, then they become a weighing machine. Is the stock market a good place to be? And historically it has been. Playing the long game significantly increases likelihood of generating positive stock market returns. So that's our first takeaway. It's time in the market. It's not trying to time the market. The second takeaway is don't try to invest based on your political affiliation. The following chart shows how the stock market has done during each year of a presidential cycle, going back to President Hoover in 1929. And what you'll see here is that the stock market can be positive or negative, whether a blue Democrat or red Republican happens to be in office. It's very difficult to put a pattern to whether the market does well over better with one political party. But it is important to note that 67 of those 92 years, 73% of the time, provided positive market performance. Those are pretty good odds. And the average for a 4-year presidential cycle was the S&P being positive 46%. So the odds are good of the market doing well regardless of who's in the office. But what is a pattern is when we look at the years of a presidential cycle. The first year of a presidential term, the market averages 9.8% per year. The second, a little bit less, 8.4. The third being the best of the 4-year political pattern, with the market averaging up 17%. The second best year of a presidential cycle happens to be the 4th year, where the market's up 10.19. We're in the 4th year right now, and last year followed the same pattern that we've historically seen. So we encourage our clients to look at the pattern of equity market returns for presidential cycles, not necessarily for is a Republican in office or a Democrat, and should I sell everything because one party wins the White House. We think that that is a fallacy. So once again, don't invest based on political affiliation. The third, we encourage you don't invest based on how you feel emotionally, whether your sentiment happens to be positive or negative, because history has shown that that's a fool's game. Once again, we like to back things up that we say. So the following chart shows investor sentiment, looking at whether people are more bullish or bearish. And the green and the blue represents whether people are more bearish or more bullish. And we can see that, as you would expect, that there are times consumers feel much better. And then we go through economic cycles where they might be real negative. And then the orange shows how the S&P 500 has performed over this time frame through the end of 2023. Stock market did very well regardless of whether people were bullish or bearish. Another way to look at consumer sentiment would be the Consumer Sentiment University of Michigan Consumer Sentiment Index. And what we did here was we plotted out at times where the index hit peaks and valleys. And then we said, well, okay, well, let's see if consumers are right. If they're real negative, does the market do poorly or better over the next 12 months, and vice versa if most people are feeling real good? And so let's just look at how the market has historically performed when consumer sentiment hit real high points. August 1972, people were feeling real good. How did the S&P do over the following 12 months? Down 6. The next time it hit a peak, May of 77, 12 months later, we were up 1.2. 84, not bad, up 13.5 12 months later. But then 2000, it was down 2%, up 4.4. January of 07, down 4.2, down 2.7, and one notable exception, February of 2020, people were real feeling positive, and it was up 29% 12 months later. But then we go to April of 2021, and then the market dropped 1.2 over the following 12 months. Well, then we said, okay, well, if investing based on everybody feeling real positive, if that's not the best strategy, then how about if we invest when everybody's negative? So here's a consumer sentiment index looking at valleys when people are just in the pits. February 1975, consumer sentiment, we're in the end of a recession. People are feeling really negative. 12 months later, the market's up 22%. The next time up 20. The next time up 29. The next time up 32. The next time up 14. The next time up 22. Up 15. Up 43. What is this trying to tell us? Well, Warren Buffett, he coined the phrase, be fearful when others are greedy. Be greedy when others are fearful. And this chart proves it. Whenever people were greedy and they're feeling really positive, that did not speak well for equity prices. But when people are in the dumps, when they're fearful, that's the time. It's when blood is in the streets. Now, where is the consumer sentiment right now? Well, it's below the 50-year average of 84.7. We're at 78.8. It is climbing. That makes us a little nervous, but it's still not real good. And so once again, what's the point that we take from this is do not invest based on how you emotionally feel. Historically, that's been the absolute worst thing to do. The next lesson is expect volatility. Volatility is going to happen in any market environment. We can't avoid it. But volatility does not necessarily mean negative market performance. This chart you may have seen before. It looks at intra-year declines in the S&P 500, which is the red, and then it looks at how the S&P 500 did over the following that calendar year. So in 1980, there was a 17% decline at some point in the year. Imagine people are in the dumps, 17% double-digit decline, but the year ended up 26%. Volatility did not keep the market from growing. It just meant that there was a pit in our stomach at some point, but it still ended up good. And if you average all of these intra-year declines, what it tells us is that on average, the market drops 14.2% at some point every single year. That being said, the market was still positive 33 out of the last 44 years, pretty good odds. So 24 times since 1980, there's been double market corrections, but 75% of the time the market was positive. Pretty good odds. So expect volatility moving into this year, but don't let that volatility shake us from our long-term goals. So remember, we're not traders, we're investors. The fifth lesson is planning is better than reacting. Planning. It's important to have a plan. As you can see from this chart, the timing of retirement withdrawals are really important. That's the one thing we can't control is the sequence of returns. We know the market is averaged. This looks at two different investors. They both invest the same dollar amount just 3 years apart. The person in red, well, they invest in 2000. Little do they know that we're about to have the dot-com bubble burst and we're about to have a double-digit decline in the stock market. They invest $500,000. They begin 5% withdrawals adjusted for inflation. Unfortunately, they run out of money by 2012. The second person invests the same dollar amount, same withdrawals, but they do it in 2003. And their ending value after 15 years is they have more money than they started with. So a variable when it comes to investing is the time frame that we're investing. And that's what people rely on us for, is they don't know what the market is going to do in the future, but they've got to have a plan to make sure that they're not withdrawing from investments that may have declined during a market correction, which is what doomed the first person in red. One thing we've got to think about when it comes to our investing is making sure that we account for inflation. If we invest $100,000, or in this case, let's say that we spend $104 in 1 year of 4% inflation, we need $104. That makes sense to all of us. But over 20 years, that same $100 worth of goods is going to cost us $219. That's over 20 years of just 4% inflation. So the question is, are you considering inflation in your portfolio? That's the reason that people have money in equities. It's not because they love volatility. It's because they want to see their money over long periods of time beat inflation. So what kind of a plan can help us account for volatility, but at the same time inflation? We like to think of investing in looking at different time frames. in putting money into buckets for different time frames. So in this case, imagine that you are putting money away for the first 12 months of your retirement. Well, that should be super conservative and liquid. On the flip side, money that we don't need for 11 years, we don't need until 2035. Well, over a long period of time, we can afford risks there because we know that over longer periods of time, the market smooths out and has positive returns. And so in putting together a portfolio, we structure it so that we put money into different buckets based on different time frames. That then is planning rather than reacting. It allows us to focus on what's most important. It allows us to tune out the noise, and instead of making a wholesale change to a portfolio all because of what the market's doing today, and we make changes to money that we don't plan on touching for 11 years, well, it takes that out of the equation. So we are able to put it into different compartments and keeping risk down in money that we need the next few years. It's important, having a plan allows us to focus on what is most important. Steve Covey is a writer that wrote a book called The 7 Habits of Highly Effective People. And in that book, he talked about the circle of influence. It was a concept that referred to things that an individual has control over, such as their behavior, their attitude, their actions. One way to examine what's within our control is by looking at where we spend our time and energy. We all have a wide range of concern, right? Because there's the circle of influence, that's what we can control, and then there's a circle of concern. That's things we absolutely can't control. But things we can be concerned about: our health, our children, the national debt, looming war, the election, and so on. We create a list of our concerns. It can be easy to start to see that what things we spend most of our time and energy on. Is it the things we can control or the things that we can't control? When we stay reactive to events outside of our circle of influence, the things that we can control, we begin to focus more on things that stay in the circle of concern. Reactive people, they focus on the weaknesses of other people, the problems in the world, the circumstances over which, once again, they have no control over. As reactive people spend most of their energy in focusing on events or circumstances out of their control, combined with neglecting the areas that they could do something about, their circle of influence, well, that begins to shrink. It becomes a self-fulfilling prophecy as more events in our life seem to be completely out of control. Why? Because that's all we're focusing on. Proactive people, though, they focus their efforts on the circle of influence. They focus their efforts on things that they can do something about. The nature of their energy is positive. It's enlarging, it's magnifying, causing their circle of influence to increase over time. What's the takeaway? Building a habit of focusing on what we can control can help us plan effectively for the future. It can help us to navigate the uncertainties and tragedies of whatever may come and ensure that we're focusing our time on what's most important. So what can we focus on? What can we control? We can control our health and hopefully our longevity. We can focus on, or we can control our planning for inflation and having good goals and minimizing taxes and controlling our risk tolerance and how much money we spend. And we can control whether we stick to a disciplined financial plan or not. We can control how much news we listen to. We can focus on our strengths. And by doing that, what it does, focusing on what we can control, then it seems to push out the noise, the things that we can't control. And so what we're encouraging all of you to do this year, with a lot of uncertainty, is focus on what we can control. Focus on having a disciplined financial plan and allowing us to help you navigate through this uncertainty. Be proactive. Be a planner, be an investor, not a trader. Ladies and gentlemen, it's such a privilege for all of us at our office to work for you, and it's also a privilege to be able to manage your assets. And in conclusion, in behalf of our entire firm and specifically the investment committee, we want to thank you for the trust that you put in Fross and Fross Wealth Management. You might have noticed our tagline is friends and family, investing and life